Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media, like I normally do. I'll interject my financial opinions as I go through it, generally related to three different topics: wealth building, commodities, and/or financial topics. So let's dive right in, take a look, see what's going on today. If you want to follow me, it's at _finance, and if you want to join our community, finding-value.com. That's where I go through all this stuff. I look and I find opportunities. I dig them up in different sectors. And you know what? Some of the people that are a part of the community also find really good opportunities in the market, and I share them with everyone. I look for speculative companies, cash flow companies, dividend paying companies. I do not discriminate against any of them. If it's a great opportunity, I'll share my opinions about the opportunity with everyone, a little bit about the companies themselves. Sometimes I do deep dives into them, sometimes I don't. Sometimes I do, I listen to their earnings calls and share what I have heard in those earnings calls with people, and share my opinions about the allocation size that I'm going to put to those companies. If that sounds like something that you're interested in, special is a coupon code that you can use, 50% off the first month only on a monthly discount, and a larger $100 discount on the yearly membership if you'd like to sign up, use special as the coupon code. All right, starting with my own post, uranium to gold and oil to gold ratio. Well, why the heck are we looking at these? Well, during certain times, uh, during certain times or different market conditions, this will go up in inflationary market conditions, rising inflation. During disinflation conditions or a pullback in the market, we'll call it in inflation, we can have gold outperform. Right now, gold's been outperforming. It's been outperforming uranium. It's been outperforming crude oil, which I'll show you here next. It's important to understand that a lot of these sectors don't move all at the same time. They move at different times. So it doesn't mean that I can accurately predict the exact bottom and top of when these sectors move. What I'm stating is it's probably good to think about this on a holistic basis of how can I set up a portfolio where you've got some moving up while others are chopping sideways. And then another sector, when that starts to chop sideways, other sectors start to move up. So you get this nice kind of steady progression up in the portfolio spread across different sectors that perform differently under different market conditions during a big old commodity bull market that we are in. The bottom here was here in 2016, 17, 18, and then the other bottom was in 2020. That's the double bottom, the breakout, and we're doing what I call is a retest. So a lot of the times you have a base. That's what this double bottom is. You break out and then you get a retest. And the majority of inflation sensitive assets are in this retest area. Coal, oil is really low. Copper was there, but that's already breaking higher. Silver, not silver, but steel was in the same situation too. So I think that this is just a retest of this ratio, and that we're about to embark on another surge higher for uranium outperforming gold here at some point over the next, I'll say, year. It would be my guess. Now, that doesn't mean the equities aren't going to front run this. The equities are going to front run this. So if you start to see the equities really start to move, people are positioning for this to work its way on up, which we're seeing. Now, if I go to URA, now that's called positioning here. This is your falling wedge into a double bottom, just like we were looking at with that double bottom there. This is wave one, wave two, and then we're entering wave three. Well, this one's it's already going. So URA looks absolutely fantastic, and we are seeing positioning in the equities. So more than likely, we're probably going to see this bottom here at some point and start to turn higher. That would be my guess. Crude oil is another one. It's a more inflation sensitive asset. Gold is the sniffer of monetary creation. Oil is the realization of money creation or monetary expansion. So I think we could get a slingshot here. This is a falling wedge and a three hump consolidation, and we got a little bit. I call this slingshot number two. Slingshot number one was 2020, where we slingshotted out of this falling wedge, that white falling wedge there, to the upside. Now we're doing another falling wedge, which I think we'll get a slingshot number two. I think this is a shoulder, a head, and a shoulder. And then we're going to move on up at some point. So what I'm trying to say here is oil is incredibly cheap. And opportunities are there to be taken when people are not looking. Now, I think a lot of the oil equities have probably already bottomed and they're starting to move higher, just like the uranium equities. So these ratios, they tell you what's cheap. They tell you where to look, but they don't give you the exact timing. They give you protection. It's like you're walking out, you're walking outside and it's like an umbrella. If it starts to rain, you've got the umbrella and then you can use that umbrella, protection against the rain, so to speak. This here just gives you coverage because you're buying something that you know is cheap historically. That's what the ratios really use as a guide. It tells you if something's cheap or expensive. And then the equities, you want to get into the equities to see where the actual entry point is. And then here, in my opinion, the entry point is here and here, if you can grab that one last time. And a lot of the times you'll get one kind of washout sale here, like that in the circle there. That's a washout sale. It scares everybody before an opposite move comes. So you really have to know what you're doing to make big money in any of these sectors. Because if you're just trying to trade the short term, people are going to get scared out. That's a big pullback. That's $33 down to $20. That's a big pullback. And it scares people, and it scares people out, which then reverses. So I think we have a big move in uranium and oil and pretty much all commodities coming, where we're seeing the same setup, and it deals with dollar weakness. Dollar weakness is the root cause of these big moves. So that's what I think is occurring here. Here's some other ratios. So this is another thing that I look at. Platinum is a more inflation sensitive metal versus gold, which is a safe haven asset. So when they say that gold leads because it sniffs out monetary expansion and it goes up during the safe haven aspect. So when the yield curve, or when you get disinflation, so when inflation is slowing down, they consider that a slowdown in the economy. That's when you go to safe haven assets like gold. So gold goes up, and then silver is kind of like in the middle stage of that, where it's not really a safe haven, but if money gets printed, silver starts to fly, which we're seeing right now. And then platinum is the realization of monetary expansion coming through the system. So gold front runs it because it works in a slightly different market condition. Silver's in the middle, where when they print money, it just rips, and then platinum comes right behind it. So when we look at these ratios, they're telling us something. They're telling us that from early 2000s, platinum outperformed silver, but then we went into what I would consider to be a disinflationary environment where platinum became out of favor. We weren't in big inflation. Now, there were times that were big inflation in here, but it wasn't a steady inflationary cycle. We had a declining interest rate environment, and all that stuff matters to create this pattern. Now you can see how we're squeezed into a falling wedge where the buyers equal the sellers into this corner here. And if you look, you can see that we're putting in a big bullish engulfing. We kind of broke out, we fell to do a retest on smaller selling pressure, and we're putting in a bullish engulfing today. Today being the 23rd of September that I'm taping this. So that's what I see. We could see an outperformance of platinum over silver. And what does that mean? It means our inflation-sensitive assets are about to do a little bit of a rippy-rippy. Uranium, oil, iron ore, steel, copper, all of them could start to firm up here. And silver could outperform gold, but platinum may run faster than silver. Here's another one, platinum versus gold. Last bull market, we could see that the outperformance from 1998 when we squeezed up, that was the bottom of the commodity bull market. And we ran all the way up to 2001-2, and then we did another double top in 2008. This was in a more inflationary environment versus gold. We had the disinflationary environment from 2008-9 all the way down to where we are today. And today, we have a broken downtrend here and another broken downtrend today, 923, that we could be starting to head higher, which will then push us out of this bigger downtrend falling wedge pattern here, which will kick us out of this. If it kicks us out of that, man, did I buy the bottom of platinum. And then we'll go into this big commodity bull market. That's what it would suggest. And maybe we can get back up to this upper trend up here, up to 2.2. If we do that, oh my goodness, would I have made a lot of gold metal ounces by acquiring my platinum down here. I'm playing the ratio to the fullest here. So I'm looking for this to break higher. That's what I am watching for. Not predicting, I'm just watching for it. Break wave, we've got freight futures AM update. Dry bulk, Capesize up 2%, Panamax up 1%, tankers, VLCC up 2%, Suezmax is flat. You know, the tankers are pretty good. They do. They look good. Those charts, they look good. Here's oil, and that also deals with tankers and other energy-related assets that we are looking at. So oil is in a wildly obvious bullish setup. Absolutely obvious. Okay. So we've got a three-hump consolidation. So this three-hump consolidation from 2008 to 2020, let me point something out here, connect some dots for you guys. You see that three-hump, the three humps here? Let's go to the platinum to gold ratio. That consolidation that we're seeing in oil is from this ratio to 2020, which is here. That was the downward move, was a disinflationary environment where oil underperforms. But oil has broken out, right? That's what this is. It's broken out of that consolidation, and then it's consolidated on top of the pattern, which is bullish. Oil is going higher, guys. It's going higher, in my opinion. And that's from looking at the chart. So it's obvious, correct. And this is a falling wedge ready to break out at some point in the future. Platinum will also break out here roughly at the same time that oil does, would be my guess. Gary says, Goldman Sachs warning is stark. A scenario where Fed independence is damaged would likely lead to higher inflation, lower stock and long-dated bond prices, and an erosion of the dollar's reserve currency status. They just described the market condition that I think is coming. Let me read that one more time. It's a scenario where Fed independence is damaged, would likely lead to higher inflation, lower stocks, and long-dated bond prices. That is an increasing interest rate environment with high inflation and interest rates going above 5%. That is the market condition that they just described. And that's the one that I think we could see lower stock prices under. Totally agree. Totally agree. In such an environment, gold becomes not just an alternative, but the only viable store of value that doesn't rely on institutional trust. That's why we are beginning to see the 60-40 portfolio allocation changes coming. This is the huge paradigm shift that I've been talking about. I recently went on the website and talked about different asset classes and money flowing between different asset classes. The market condition that's coming, more and more asset classes do not work under that market condition. And more money is going to be forced into fewer options. And the options that are going to work, gold, silver, platinum. And we're going to start to see these things be thrust to levels that people are not used to. And it's going to do it at rates that people are not used to. This is where people have heard me say you get many decades of return in less than a decade. And it happens very quickly sometimes. Now, I don't know for a fact how fast it will happen. But a lot of the times when your options become limited and more money gets funneled into less options, it happens pretty rapidly because more money is chasing smaller and smaller sectors. And I think that's the conditions that are coming. That's what I have positioned for in 2020, 21, 22, 23, 24, 25, and picking off bottoms in all these different companies and using technical analysis and the ratios and all that stuff. I am deploying every single thing that I know about the market to find these companies, to take advantage of this market condition that is coming. Grady says, been posting many charts that show that this is a lifetime commodities opportunity, was about to once again go into overdrive. Been saying and posting that a big move for the TSX Venture is coming, and it has now started. This ratio chart below has caught all previous big up moves. This chart shows how historically undervalued small and mid-sized commodities companies still are versus the commodities index CRB. So think, for example, GDXJ versus gold, SILJ versus silver, URNJ versus spot. Many will now talk like they saw this coming, but they did not. Go with the service that has actually been on track all along and who has actually saw this coming. What is coming and is here now was also posted in this article. He talks about how he's getting it right, basically. So TSX Venture versus CRB, you can see the TSX is starting to really take off. And the TSX is a smaller Canadian commodities companies versus the commodities index CRB. And this is where we're outperforming. And I'm sure you guys have noticed that your portfolio has been going higher. It is of no surprise that things have been moving quickly. Tavi, so remember about that dollar I was talking about earlier. Today, a new set of structural pressures has brought the US dollar to a critical juncture. The history of the US dollar cycles and that we could be breaking lower here. If we break lower, look what happens in this cycle. This is a cycle that we've got a cycle going on here, right? We have tech bubbles at the top where money flows into US equities and the dollar strengthens under those environments. Conversely, money flows out of US dollar denominated assets into other assets where the dollar weakens. This is where US equities are undervalued and commodities are undervalued here. US equities are undervalued, commodities are undervalued up here. So commodity undervalued, commodity undervalued, commodity undervalued, and these are US equities undervaluation. Another one from Tavi says, major macro trends tend to be confirmed by decisive multi-year breakouts. The mining stocks to gold ratio appears to be doing just that. Despite the recent strength, we are still more than 70% below the highs from 19 years ago. This could mark the beginning of the institutional phase of the cycle, where patient capital starts positioning for long duration exposure. Gold miners to gold ratio is just starting to break out. And people are going to notice here, guys. This is just the beginning. What does that mean? It means that we are just breaking out of bases or coming off the tops of retests of bases. We're going to go into a long burn bull market, in my opinion. Long burn means that it could happen for many years, not just months. What we saw in the movements in gold and silver, even during the 2000 to 2011 bull market, we're in a declining interest rate environment. That environment's gone, guys. It's gone. That move was a part of a move lower. Look at this was the last bull market from 2000 to 2011. We had gold miners go and underperform gold during that time frame. And that was in a base of a lot of these technical patterns. Now we are coming out of bases. Totally different mindset should be applied here. The mindset of the old, oh, well, I went through the 2011 bull. That's not a bull market, guys, compared to what I think is coming. We're going to have more money rotation, less options where that money can rotate. And I think the market, the moves could be a lot bigger than previous bull markets, like 2000 to 2011. It's going to be more like the 1970s bull market. It said patterns are similar. Uranium looks really good. So this is GDX. That's already broken out. You see this big bull flag? This is the double bottom. This is a bull flag that came back to support. And then now we're entering the big bull. Now it's been going quite vertical. And sometimes you can get consolidations and stuff like that. But we've had a big move out of this, right? Look where uranium's at. It's the same pattern. The breakout of the base, the retest, and now we are just starting to launch. There we are. It's going to do the same thing that GDX is doing. It's going to keep going, is in my opinion. And that's all I've got for today there. So that's where we're going to end it. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Specials coupon code. And that's all I've got for today. Look for a Platinum midweek update where I go over individual companies, share my opinions about those individual companies and what I think looks good for setups. All right, guys, that's all I've got. See ya.